break it down into AMC, just like the simple terms of why it happened the second time. So basically, the manipulation side. So an analyst came out and put out a report on AMC basically saying that the stock price of AMC was going to $1. And so it's trading at what, like $9-10 a share. And this analyst comes out and says, hey, investors, watch out. Whoever owns AMC, I'd be weary. That stock's going from $9 to $1. And what they do is they try to scare everybody who owns it, thinking, oh, I don't want to lose $8 a share. I'm going to sell. I need to get out now. I need to get out. And what that mass selling does is drive the price down. And ultimately, they would be able to, buy 100 shares at $9, pay $900, sell them. Or I'm sorry, borrow the shares for $900, immediately sell it for that $900, and ideally drive the price down to $1, buy the shares back for $100, and make $800 when they delivered it. But like David said, this data is public information. So they're releasing this short interest on a regular basis in reports, which allows investors, retail investors, to run charting and different metrics to see how much short interest is out there. And there's certain thresholds that are attractive as someone who might be a short squeezer, because they realize, hey, there's people actually out here trying to drive the price down, so they have borrowed shares. And in that case, everybody piles in, herd mentality on Reddit, and get as many possible people to buy into the stock, drive the price up, and then you get, obviously, like kind of David just mentioned, we get to where we're at, where we're driving the price up, and then time comes for the shorts to repay their shares, so they got to go to the open market and buy, and now they're buying at the higher price and driving the price up exponentially, like David said.
Plus, the margin rate is not cheap.
No, not at all. And when you buy, I don't know how it works for hedge funds.
Wasn't it 3 1/3, something like that?
I mean, I don't know about margin for hedge funds, but what I do know is that the margin requirements to buy or borrow AMC shares or any of these meme stock shares, and maybe this rule doesn't apply to the big guy, probably doesn't, but you like at Wells Fargo, some of those different banks, you have to cover 100% maintenance margin.
Right. So I don't know, let's say it's 8% interest, for example, on $100,000. You got to pay that. Yeah.
And make sure the right amount of money's in your account at all times.
Well, that's the thing. Maybe people should understand, when you buy in margin, you have to have the stock in the underlying position. So if it's Microsoft, for example, if I'm going to go out and borrow shares of Microsoft, or I need margin to cover it, I have to have that backed up in my account with the Microsoft and actual shares, so they can come after the money. They don't just do it on faith and say, okay, well, all right, well, you owe me the money, we'll get it eventually. Like, they need to make sure their positions are covered.
Exactly.
All right, so
that kind of ties. It's morbid, but that one kid who, unfortunately, he with the way that margin works and the interest rates and running your money up and having maintenance margin, and what that means is basically after a certain threshold, you have to keep a certain amount of money in your account, and if that amount of money is not in there, you can get called, and essentially you have to deposit new cash into your account.